Happy New Year, everybody. And let's hope 2023 is a little less volatile than 2022. But that said, we're kind of facing the same dilemma that we were coming into last year, which is the market versus the Fed. In 2022, it was, the market saying inflation is going to take off and the Fed saying, no, it's transitory, and we know the outcome of that. The market was correct. This year, coming into 2023, the market's saying, inflation is going to fall, interest rates are going to fall as well, and the Fed saying no, inflations are going to be a little bit more sticky, and we're going to have higher rates for longer. So that's the dilemma, and I think the market kind of falls into three camps: stagflation, recession, and deflation. We're kind of more in the kind of deflation, recession camp. We think Europe's probably in recession if the figures start to show that. We think the US might skirt it, might go into a mild recession this year. But what we're keen to say is that the Fed at some point in the first half of the year will go on hold on interest rates. And we think that's going to be around a terminal rate of Fed funds of around 5%. So that's the good news. At some point, the Fed in the first half will go on hold. Now, once that happens, and we talked about this many times over the past year, is that once that happens, investors will start to look at where will the growth come from going forward. There'll be recovery in Europe, there'll be recovery in the US, but where's the big growth going to come from? And that's going to come from emerging markets. And that's where we think that the flow of funds will be starting to come through. And the good news with this is that China is starting to reopen very quickly now. And that will add growth to the Asia story. Now, will India outperform in that? Probably less so, because some of those markets in terms of the valuations are cheaper, but we will get funds flow. And that's what the market's been missing. So we're more constructive for 2023. Yes, there could well be downsides to the market, as some of the data is still kind of a little bit higher on inflation in over certain months, but we feel that the market's had that bottoming out process at the moment, and therefore we feel that this year could be a lot better, maybe from the second half onwards. But I wouldn't be surprised if you see the markets trying to rally into this in the first half. Worst case is the Fed's right, and interest rates have to stay higher for longer. Then obviously, the aggregate demand will fall, and recession will take a little bit more in terms of a bite out of the US economy, and therefore the Fed will at some point have to reverse that and pivot into the second half of the year. So that's why we're more constructive. We feel the Fed at some point will pivot.